An automated inventory management system will cost rupees 100 lakhs. It will be depreciated on straight line basis over 4 years, and this is okay for tax. The system will have an useful life of 5 years. Either at the end of the 4th year or at the end of the 5th year, it can be disposed of for rupees 20 lakhs. The system will annually save rupees 30 lakhs before taxes and inventory related cost. The tax rate is 30%. The new system will free up 10 lakhs by way of working capital immediately. This money will have to be put back at the end of the life of the project. Decide using a discount rate of 10%. So you have to decide whether you should invest in the project, and the life of the project is actually 5 years. So you can close it over a period of 4 years or 5 years. If you're going to close it over a period of 4 years, then right from now you have to calculate depreciation for 4 years. If you are going to close it at the end of 5 years, right from now you have to calculate depreciation for 5 years. And the disposal value is going to be 20 lakhs, and when it is sold, then working capital will again come into picture. So 20 lakhs, if you are going to sell, you have to incur 10 lakhs on working capital, so your net salvage will be only 10 lakhs. Okay, so what we'll do, let's start calculating the NPV, assuming the project is going to be used for 4 years life. Okay, because it can be sold at the end of 4 years or 5 years. We have two scenarios. So let me increase. Yeah, I'll call it as situation 1. Situation 1, computation of NPV if asset, if say that if system is going to be used for 4 years. So we should know what is our initial investment. So working note 1, computation of initial investment. What is the cost of the system? The cost of the system is understood as 10 lakhs. Okay, so item A cost, let me make it clear. Yeah, cost of the system, and how much it is, 100 lakhs. Okay, and let me make it here figures in lakhs throughout this problem. Okay, now when I go for the system, my working capital gets released, right? So less release of working capital, and how much is that? What information we have? The working capital that will be released is going to be 10 lakhs. Okay, so it's 10. So here I can write net investment, net initial investment, and that's nothing but A minus B. So it's 100 minus 10, that's 90. So this is my net initial investment. Okay, then I have to calculate the cash flows, and for calculating cash flows, what is required is you should know what are your savings, what are your expenses. Okay, and expenses include depreciation, so I should calculate depreciation as well. So working note 2, probably I'll carry that working note here. Working note 2, computation of depreciation, right? So what is the cost of the asset or cost of the system? Cost of the system, already we have calculated or we have written, it is 100 lakhs. And what is the estimated salvage value? I'll write estimated SV, salvage value, it is 20 lakhs. Okay, so it's going to be 20. And so what's the depreciable amount? Depreciable amount is nothing but A minus B, depreciable amount, and that's going to be A minus B. Okay, so it is 100 minus 20, that's the depreciable amount. And we know the life. So now the assumption is we are going to use it only for 4 years. Okay, uh, but the life can be 5 years. But let's say we are going to dispose it off over a period of 4 years, will not carry it till 5. So in that case, life will be treated as 4 years. Then we can calculate annual depreciation. Annual depreciation, and that is item number C divided by D. So it's going to be 80 divided by 4. So what we get is annual depreciation, and that is 20. Okay, so once I have annual depreciation, I think I can go into the cash flows computation. Working note 3, computation of cash flows. And what's the life? It is 4 years, right? So every year the expected cash flow we have somewhere here. Every year the expected cash flow is 30 lakhs. So let me write item A, expected cash flows. And for how many years? It's going to be for 4 years, right? So let me write the years. It's 1, 2, 3, I'm sorry, 1, 2, 3, and 4. Let me take them to the next row. Yeah. So let me make it a little clear. Fine. Yeah. Expected cash flows in all the 4 years are 30. But from this I can subtract depreciation less depreciation. So what is the depreciation we have calculated? It is 20 lakhs. So every year I'm going to have this 20. So let me carry this. So now I can have earnings before tax, EBT, and that is nothing but A minus B. It is A minus B. Okay. So it is 30 minus 20. So earnings before tax is 10 lakhs. And let's check what is the tax rate. Tax rate is 30%. Okay. So item D, less tax at 30 percentage. So it's going to be 10 into 0.3, so it's 3. Okay. So this is your tax rate. Now item E, where earnings after tax. Earnings after tax is nothing but C minus D. Okay. So this is 10 minus 3. So earnings after tax are 7. And with this we'll add depreciation. So we get cash flows after tax. Cash flows after tax is nothing but our earnings after tax of E plus depreciation of B. Okay. So it's going to be the 7 plus depreciation of 20. So this is our cash flow position. Okay. So we have cash flows like this. Then we also have terminal cash flow. We should not forget that we'll have it through a small working note. This is working note 3, computation of cash flows. We'll have working note 4. Okay. Working note 4, computation of terminal cash flow. Terminal cash flow in that item A is sale value of asset. Sale value of asset. What is the value at which this asset is going to be sold? It's going to be sold for 20 lakhs. Okay. But working capital have to be reinstated. Okay. Less question says the working capital got to be put back. Okay. So less restoration of working capital. And what's the figure? It's 10 lakhs. So what is the net salvage value or net cash flow from salvage value? Net cash flow from salvage value, that's going to be 20 minus 10, that's going to be 10 lakhs. So in this way we have the salvage value, we have the cash flows from operations, and we also know what is the net initial investment. Okay. So now with all this information I think we can go and find NPV. Let's have working note 5. Working note 5, computation of NPV. Okay. So let's capture the year 0, 1, 2, 3, 4, and cash flows. What is the cash flow in year 0? What we have calculated is 90. Then cash flow in year 1 is 27. And I think year 2, 3, 4, everything follows the same. And in year 4 we have another cash flow, that is the terminal cash flow. How much? We have terminal cash flow of 10. Okay. Now these cash flows have to be discounted. Discount factor. So what's our discount factor? At 10%. Discount factor at 10 percentage. So it is 1 divided by 1.10 to the power 0. That's the period. So discount factor for year 0 is 1. Year 1 is 0.909. Year 2 0.826, year 3 0.751, year 4 0.683, and that should be repeated. Then we can find the present value. So the present value is here. This 90, let's please capture it with a negative sign because it's a cash outflow. Okay, so 90 into 1 is a cash outflow of 90, and in other cases they're all positive cash flows. Inflows 24.55, and it goes. Now if I total all this, I'll get the NPV. If I total all this, I'm getting NPV as 2.42. So this is the NPV if the company is going to take up this system and use it for a period of 4 years. So this we call as scenario 1. That is, in scenario 1, if they use the asset for 4 years, the wealth that is going to be created for shareholders is 2.42. Now let us also talk about scenario 2. What I'll do, I'll just make modifications in all this calculation, but you have to try it independently, because when you solve them, you have to try them independently. Now let me just give the summary here somewhere. Okay, NPV in scenario 1 is 2.42, and this operates under the assumption of 4 years life. Okay, now I'll modify this. I'll call it as scenario 2. Scenario 2, and the life is going to be how many years? Life is going to be 5 years. So life will be 5 years. And cost of the system is 100, release of working capital is 10, net initial investment is 90, no change in that. But there is going to be a change in depreciation. Cost of system is 100, estimated salvage value is 20, depreciable amount is 80, but this got to be depreciated over a period of 5 years. So the annual depreciation will now become 16. Then we'll go to working note 3, computation of cash flows. Already we have captured the expected cash flows. Now depreciation will be 16 and not 20. So our EBT is going to be 14. And we have to apply 30% tax on EBT of 14, which is 4.2. So you get EAT as 9.8. And with this, if you add back depreciation of 16, you get cash flows after tax as 25.8. Then working note 4, where we have to capture the terminal cash flows, where the asset is going to be sold for 20, restoration of working capital is 10, so net cash flow from salvage value is 10. Then we go for discounting of the cash flows, and the year is going to be year 0, 1, 2, 3, 4. We'll have 5. Okay, why? Because the life of the asset is undergoing a change, so we'll have 5, and we'll have one more 5, because this 5 will capture the operational cash flow and this 5 will capture the salvage value. And let us capture the cash flows. This 90 is correct, okay, because I'll show you from where we got this 90. So we have picked up this 90 from here, so nothing wrong in that. Okay, then what about the year 1 cash flow? Year 1 cash flow we have picked up from here, it is 25.8, fine. Year 2, 3, 4 is fine. Year 5 should also be 25.8. Then again in year 5 we have to capture the net cash flow from salvage value. Fine. Then let's check the correctness of discount factors. Everything is fine. Year 1, 2, 3, 4. And let me calculate for year 5, which is 1 divided by 1.1 to the power 5, and it is 0.621, and that should be repeated here. So when I do this and when I multiply the cash flows with a discount factor, I get the PV. Okay, and this calculation tells me my NPV in scenario 2 is going to be 14.01. So let me write NPV in scenario 2, okay, is 14.01 when the life is 5 years. So this communicates that this project is basically a positive project, whether you use it for 4 years or 5 years. But if you're going to use it for 5 years, the wealth that is going to be created for shareholders is much more than the wealth that is created for shareholders over a period of 4 years. And what is the incremental wealth you are going to get by using it for one additional year? It is 11.59. And why did this happen? Because you were getting an cash flow, exclusive cash flow in year 5. So using the system for 5 years will be more beneficial for this organization.